All right, you guys, this is Michele Zaragoza, team leader for Central Valley Realty over at Keller Williams, Tracy Lodi, Stockton, Manteca, Modesto. We have a special guest today, Tim Wheeler, CPA. Everybody wants you to work on their books, Tim. Like I said earlier, everybody wants Tim's number. Everybody wants Tim's email. So we kind of thought this would be the best form. They can ask questions right here, right now, because we all know you are not taking any more customers. So I'm repeating this. He is not taking any more customers today. However, I'll let you say whatever you want to say about what the future may hold. But today he is not taking any new customers. So can we all please remember that? All right, Tim, I'm going to just pass it right on to you because you do know what you need to share with us, all the little changes, and maybe go over a couple of the same things that we've talked about in the past because there are some new agents on Zoom with us right now.
Sure.
Thank you.
Yeah, you got it. Thanks for that wonderful introduction, Michele, as always. Hey, I I see a lot of familiar faces, so hi to everyone I know. I see all you guys, so it's good to see you. Um, because I now live in Montana, I have to fit in, so I grew out this thing right here, and I haven't
I
cut my
like
hair
it.
in a long time. Yeah, so I've gotten all fuzzy. But um, hey, so I don't have a ton of new information for you guys today, so I plan on kind of going over some old things. There's a few updates, but very minor. You know, a lot of the big tax law changes have happened 4 years ago and then 1.5 years ago, and so there's not a lot new for 2022, but there are a lot of little refreshers, and I understand a lot of you may be newer agents, relatively new in the industry, and so. I'll go over some kind of the main highlights of a few things that I typically tell real estate agents about deductions and how to kind of maximize your best tax structure. But in the meantime, if you guys want to ask questions in the chat section, I will gladly answer questions throughout this whole time. And so I can either wait till the end, answer all the questions, or I'd be happy to answer questions as I go too. So feel free to use that chat feature to ask me questions for everybody, and I'll set aside quite a bit of time just to answer questions people have. So first of all, I wanted to talk about some of the new-ish things. One of the things is for last year and this year only, your meal deductions when you go out to eat at a restaurant are 100% deductible. You know, for the history of taxation since 1986, meals have only been 50% deductible. For 2021 and 2022, they're 100% deductible. So make sure you're keeping track of your meal expenses at restaurants. It's supposed to be actually a restaurant, whether you eat in or eat out, it's okay. It's not supposed to be like a gas station food or something that's kind of like more like to go in nature. But if it's a restaurant setting of any sort, you can deduct those 100%. So that's something to keep in mind for this year. The second thing is that's pretty new is I'm sure you guys have heard this new 1099K issue, which is coming from Venmo, PayPal, Cash App, eBay, all these places where people are sending people money via these apps. The IRS has now demanded that these companies issue 1099s to people that have over $600 in money coming into them, whether it be from 20 different sources or 100 or one. As long as they get over $600 paid to them through one of these apps, they're going to be getting a 1099K. So I don't know if any of you are involved in any other little side businesses or using Venmo for anything else besides you know, family and friends giving you money. It's just something to keep in mind that you could be getting another 1099 that you weren't expecting. And so just keep that in the back of your mind that that's something new for this year as well. The other new item, I don't know how many of you actually have employees. I know most of you pay a transaction coordinator, but I don't know how many of you have employees. If you have employees, and you had employees during 2020 and 2021, there is this credit called the employee retention credit, and it's a really big deal. There's a lot of money out there to get based on your employees. The max credit per employee for that 2-year period is $26,000 per employee. So if you have any employees whatsoever and you have not obtained the employee retention credit, that's something that you'll want to reach out to your CPA about. I'm even willing potentially to take on some of those cases. Even if you're not a client of mine, just because they're pretty specialized. And there's third-party companies out there that try to do these, but they charge you a ton. We're not that greedy, and so we don't charge a terrible amount to do those. Somebody asked if you're an employee of your own S Corp, can you get it? And the answer is no. You cannot. It has to be employees that are not related to you. So it has to be a true employee that's not you or your spouse or your child. I just wanted to throw that out there in case anybody does have employees and anybody hasn't heard of it, or if you have clients that that have businesses and they're struggling, or if you mention, hey, did you ever get the employee retention credit? You can send them our way. It's big money. I've actually recently filed some returns for people to get this credit in excess of $1 million. So I've had 2 companies that got over $1 million in credits. So it's a really, really big deal. Okay, so those are kind of some of the new things I wanted to kind of get through. I want to talk about the S corporation, because that's kind of the first thing we go to for real estate agents. If you're operating as a sole proprietor and your income after all expenses is in excess of around $60,000 per year, you are giving away money to the IRS that you shouldn't have to. You are being overtaxed. Having an S corporation can save you money. There are S corporate. Sorry, I just got a question from Michele. Can you have an S corp under an S corp? No, an S corp can't be an owner of another S corp. Only an individual can be owner of an S corporation. And how you would structure a team of 3 partners, I'll get into that next. But the S corporation, I don't want to get into like too much finite detail about it, but it's something that I want you to have on the back of your mind, that if you're making, after all expenses, $60,000 a year or greater, you will save money having an S corporation. You save on self-employment tax, you can save on the qualified business income deduction. You can actually contribute more to retirement. There's all kinds of things you can pay for your medical expenses through your corporation. There's all kinds of things you can do to help having a corporation. But my rule of thumb is typically that 50, 60,000 preferably number of profit to make it beneficial. And this is if you're by yourself, if it's just a one-man show or a woman show, you can have the S corporation still make sense for you. But any of our real estate agent clients that have this income in excess of that, we try to convert to the S corp because it just saves money, bottom line. If you have a team, I know you guys often have these team kind of units where maybe you have 3 people that get together or 2 people that get together, and you each do separate business, but you act as a team, so everything kind of gets split equally. There are ways to structure that so where it goes into an entity and then it gets split between the 2 people involved. Unfortunately, you can't. Preferably, you would form it as a partnership, a general partnership, and KW would pay the partnership, and then your S corps, each one of you or 3 of you would have your own S corporations that would be the partner of that partnership, and that's how that would work. I have a few clients that follow that structure. It's very common to see that in the attorney world, where you have like a big attorney office, and all the money comes in that attorney office into the partnership, and it gets paid out to the individual attorneys' S corporations, and that's how that works. So it is possible to kind of operate as an S corporation with the team as well. Again, I don't really want to go in the nitty gritty of how the S corp saves you money. But just know that it does. And there's additional write-offs you can take. Quick things, you can pay your spouse if you're married to try to get extra deductions that way, to kind of justify that she's part of your business. And you can have your yearly annual meeting like big corporations do somewhere else and run off a big trip. You can rent your house from yourself for home office use, which you normally can't do as a sole proprietor. You can there's all kinds of little things and tips and tricks you can do with an S corporation that you can't do as a sole proprietor. So just kind of keep that in the back of your mind. Another big benefit, if you have children under the age of 18, and you're a sole proprietor or you're an S corporation, you can pay them to help you in your business. This has been challenged many times in tax court, and the taxpayers always win because you are legally allowed to pay your children to work for you. No matter what they do, they can clean your office, they can take care of your pet fish, they can do whatever you want. If you pay them and you do it the right way, you get a free tax deduction. And you can pay each kid up to $12,000 per year, and it's completely tax-free to them and completely tax-free to you. It just goes to them as wages. They file their own tax return, and because it's under their standard deduction, they don't have to pay any income tax on it. And the standard deduction right now is $12,600. And so each kid can make $12,600 completely tax-free. It's a huge tax planning tool that we use for lots of clients. I have a client that has 4 kids, pays them each 12 grand a year. And so he gets to shift almost $50,000 of his income to his kids completely tax-free. It saves him about 30 grand a year in tax because of all the extra taxes involved. He also then contributes some of that money to their Roth IRA. So now they're actually building up a retirement account in a Roth IRA that grows tax-free for the rest of their life. And so there's some huge benefits to kids. If they're above age 18, the benefit isn't quite the same because you actually have to pay payroll tax on them. So you're paying into Social Security, you're paying into Medicare. But if they're going to college, you actually can have them write off their own education expense. So you can actually end up paying them more potentially, and they get to take their own education credit because maybe you make too much money to qualify to take the education credit. Then they can take their own credit and you can pay them up to 35 grand a year tax-free. So you can even shift more of your income to a college-age student if they're going to college and they're paying for it. So there are some huge benefits to paying family members, especially children. So if you're not doing that and you have children, that's something you want to look into. And make sure you don't tell them that you're paying them because then they'll ask for the money. I've experienced that one too. Let's see. Okay, some new or a question we get often from all businesses is, should I buy or lease a vehicle? That's a question I probably get more than any other question. So if you're in the market to buy a new vehicle and you're questioning whether you should lease it or purchase it, the answer is, what type of vehicle are you going to buy and how much are you going to drive it is always the question. There's no like black or white answer to this question because it really depends on your vehicle use and what kind of vehicle you plan on buying. So a general rule of thumb, if you buy a big vehicle that weighs over 6,000 pounds and you want a upfront tax deduction, the better thing is to buy the vehicle. So if you buy an SUV, even like the Ford Explorer weighs over 6,000 gross vehicle weight, one of those SUVs or trucks, it's better to buy if you want the big upfront deduction. Otherwise, leasing is a great option for a lot of reasons. You can write off the payment. Maybe you drive low mileage. So maybe the mileage is actually a better deduction for you. One thing to note is the mileage deduction did increase as of, or it's increasing next week, July 1st. It's increasing to 62.5 cents per mile. So if you're an S corporation out there and you're reimbursing yourself mileage right now, starting July 1st, you want to increase that reimbursement for mileage up to 62.5 cents per mile. And just know it's really important to keep track of your mileage if you're a sole proprietor, because that's a huge tax deduction. Is all those showings you go to, all those open houses you're doing, it's 62.5 cents per mile. It's a big deduction. One thing to note, the IRS right now is an absolute mess. They came out about a month and a half ago, 6 weeks ago or so, and said that they purposely destroyed 30,000 information returns. Information returns are like those 1099s. So like, you know how you get a 1099 from your broker, or you send your transaction coordinator 1099 and so you had to send it to the IRS. The IRS came out and said they destroyed 30,000 of those returns just because they didn't have time to get to them. This is no joke. And so they are so far behind. And knock on wood, we haven't had an audit for like 2 years because they're not auditing anybody right now. They just don't have the capacity to actually do physical, like in-place audits. And so they're just way behind, but they're trying to catch up, and they're getting there slowly. All that to say is that there are a lot of black and white issues in the tax code, but oftentimes a lot of the tax code is a gray area. There's a lot of gray, and so if there's an expense that you're questioning whether you should write off or not on your tax return as a real estate agent, if there's a question at all, go ahead and write it off. You should take the more aggressive route on your tax deduction, especially as real estate agents. Being a real estate agent is your life. It's what you do. It's everything you do in life you can kind of justify in a lot of ways for your business. And so I just kind of want to throw that out there for you in case you were wondering about some certain expenses you were thinking of. Those are like the main issues. There was an update last week. I don't know how many people in here got PPP loans. You were able to take a PPP loan as a sole proprietor. If you did get on those PPP loans, and if you did pay tax on it, whether the IRS or California, California is updating their law to conform to the IRS rules. A lot of people actually were forced to pay tax on their PPP money to California. So if you ended up paying tax on your PPP money to California, look into that. Talk to your accountant or whoever does your tax return. It's possible now with that new law, you can go back and amend your return and get that tax money back. I just wanted to point that out real quick because I know a lot of people were getting those PPP loans, especially agents. I can take questions if anybody has them. That was kind of the main gist of what I want to talk to you about today, but I have a question here. Can an S Corp buy or lease vehicles? The answer is yes. And actually, if you have an S Corporation, in order for the S Corporation to get that tax deduction, the IRS requires you to have it in the name of the corporation. So you definitely want to put the vehicle, whether it be a lease or a purchase, in the name of a corporation. Now, if you go to a dealership, they're going to try to talk you out of putting the name of the vehicle in the corporation because they say, oh, it's a higher interest rate, blah, 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 blah. But it's worth it to have the vehicle name of the corporation for liability reasons, for the tax write-off purposes. So sometimes a dealership, if they're savvy enough, they'll put the corporation name on it and your personal name. And that's one way they get around it. So if you have both on title, that will work. Leslie asked, what about writing off a vehicle over 4,400 pounds? 4,400 is not a number that I'm familiar with, Leslie. So the number is 6,000 for the gross vehicle weight. Anything less than that is subject to an $18,000 upfront first year depreciation. So if you buy a vehicle for 25,000 and it's less than 6,000 pounds, you can write off 18,000. That's still a pretty good deduction. If it's over 6,000 pounds, you can take 100% of the deduction. Somebody said here, hi, Tom, does the child credit affect, oh, Tim, she corrected, it's Tim. Does the child credit affect child support? Does the child credit, I think what I'm asking is, if you pay your child, does that affect the child tax credit? If I'm understanding that question correctly, the answer is no. You can still claim your child as a dependent, and you still get their child tax credits. You still get whatever else your child is for. They just file a return and they put that they're being claimed as a dependent. I think Janet McMahon has a question.
Yeah, going back to that Venmo, I use that a lot for fundraisers. So I have well over that $600 threshold. Can I prove that it was a fundraiser? What can I do?
Whoever does your taxes is probably going to fire you as a client. It's probably what's going to happen. No, I kid. Venmo has said on their kind of like public arena that if you have a personal account and it's not a business account, they're not going to count those.
Okay.
I don't know how they're going to get away with that, honestly. I feel that eventually they're going to have to report on all, because then everybody would just create personal accounts for their businesses. And so I don't see how they get away with that for much longer. I don't know what PayPal is doing. I don't know what Cash App's doing. I don't know what
Zelle?
Zelle, the same thing. But Venmo's clearly said, hey, if you have a personal account, we're not going to be doing these 1099s to you.
Okay.
If it's deemed to be personal, which how they make that determination, I don't know.
Thank
So
you.
you should be okay if it's a personal account, but the bottom line is it's just something to be aware of. If you get a 1099K, we can report it and just say, hey, this was all personal stuff. This was all just my, family pay me back for dinner or whatever. And so, but it's just a matter of reporting it correctly on the tax return to make sure that you don't get a letter from the IRS.
Okay, thanks.
Janet Anderson.
Hi, Tim. Thank you so
Hey.
much for being here. This is
Yeah,
amazing. Okay, I know I'm always asking you questions, but these are the things that I'm bad at. So I just wanted to get some clarity. Logging like my gas mileage. I'm using my corporation as an S Corp, and I'm using my gas card all the time. I mean, I know we're not auditing right now, but so those questions with logging, or even like my monthly or quarterly meeting, S Corp meetings, I'm not doing that, or keeping my receipts. I always use my credit cards, but I'm horrible at keeping my receipts. So maybe can you talk on that? Because knock on wood, I mean, I'm thankful that we haven't had an audit, but just want to be proactive.
So you're telling me you're a client of mine and you're doing nothing correctly. Is that what I'm hearing? Okay, no, I'm just kidding, Janet.
Oh no, it's true.
First of all, if you are reimbursing yourself mileage from your S corporation, you shouldn't be paying for gas out of your S corporation. It's one or the other. Because you own your car personally. So if you own your car personally and you want to take the mileage deduction, which is oftentimes a better deduction, you don't want to pay for the gas through your S corporation. You want to reimburse yourself a mileage rate, at a certain point. So you don't want to be doing both. If you are doing both, it's okay. We'll just back out the gas costs from your return and we'll take the mileage deduction instead. So we can make that work. But technically, you want to do one or the other. You want to pay for all the expenses through your corporation, like gas, insurance, tire changes, whatever, or you do the mileage and you got to pay for one out of the S Corp, not both. Number two, the IRS really does require receipts. Once they get back into their auditing mode, which they want to, they've announced their intention to hire 10,000 new revenue agents. That's their fancy term for auditors. They call them revenue agents now. And they're going to be auditing people a lot more going forward. And so one of the things you do need to keep is receipts. You don't have to keep them in a reasonable, organized fashion. If you keep them chronologically, that's fine, because we have your credit card statement, we have your bank statement, so we know when it took place. So as long as they're chronological, if you just dump receipts into a folder and chronologically, and you keep those for a while, as long as you have them, we can always go back and reference them if you need to from your bank statement or your credit card statement. So it's just a matter of starting to keep your receipts. I have a big file folder that I just keep them chronologically. I kind of make a copy of it, fasten it down, and keep them chronologically. But every month I'm also going through my bank statement and doing my accounting like you are to make sure we have everything. But you still want to keep those receipts. If it's a clear deduction on your credit card, like you pay MetroList, well, everybody knows MetroList is a clear deduction. You probably don't need a receipt for that. But if it's an ambiguous charge on your credit card, like Costco, that could be anything, then you need to keep that receipt. Does that clarify that, Janet?
Totally. And then what about my minutes meetings?
Oh, we can always go back and actually do minutes. You can always go back and recreate those. So those aren't as important. I do have an Excel file that we made that actually you can kind of put in your minutes every month, and you can actually put in like the expenses you have for your house to do your home office reimbursement and all these types of things. And so I could send you something that kind of helps you keep track of those monthly kind of deductions you can take as an S corporation.
Great, thank you, Tim.
Is there a money limit for wardrobe expense? That's a great question. Yeah, there is a limit. It's a zero. The IRS says the only article of clothing that's ever allowed to be deducted is if it meets two criteria. If it's a uniform, a true uniform, like it has a logo. See my logo on here? That's why I logoed all of my shirts, and that's all I wear now, so I can write them off. Or if it's like a police officer's uniform, or if it's just an actual true uniform, or if it's protective in nature. So if you are a steel worker and you need steel-toed boots or something, or if you're in construction, you have to have a hard hat, that's part of your protective in nature, you can write those off. For everybody else, no matter what it is, technically wardrobe expenses are never tax deductible, never. That's the letter of the rule according to the IRS. So if you're ever audited for that, that's how they would rule. Is there any value to transfer a paid off car to an S Corp ownership, like on title? Probably not. There's probably not a benefit of your S Corp owning. If you've already purchased the car, it's already paid off, and you already own it personally, you're probably better off if you have an S corporation doing your mileage reimbursements. You actually physically reimburse yourself mileage every month for the mileage you're driving on your vehicle. That's going to be a better deduction, especially because the mileage rate's so high. You're going to get a big deduction for that mileage, even with the price of gas going up. The Halstead team, I see a question.
Yes, sir. Hey, on the receipt issue, we don't have to keep a physical receipt, do we? Like, we scan ours into our G drive and then throw them away.
Yeah, that's right. It does not have to be a physical copy. The IRS actually clarified that a couple years ago. I went to an audit quite a few years ago, and I brought in some copies, and they said, "Where's the original?" I said, "We don't have them," and they tried not disallowing them because that was their rule. Like, you had to have the physical copy, but nowadays electronic copies are good enough. Oh, my employee Keith Duncan, who's on the call, actually just attached to that chat an Excel document that's labeled reimbursement template. You guys can grab that for a nominal fee. No, I'm just kidding. You can grab that template and use it. It's pretty self-explanatory. You put your expenses for your house in there. You put and then it kind of helps you as an S corporation organize how much you reimburse yourself per month for the use of your home office. And so as an S corporation, the S corporation needs to reimburse the shareholder how much for the cost of their home. And that document will help you figure out what that reimbursement should be per month. And so that's a great way to keep track. So there you go, Janet. And anybody else can take advantage of that.
Thank you.
Yep.
Thank you.
No marketing shirts like I do real estate. No, that actually counts. If it's logoed or as a marketing and it has something on it that has your logo or your marketing slogan for your team or for what you do, it counts as a deduction. So it's wardrobe. Like if it's just if it's a nice dress or if it's just like a suit and tie, those are not deductible. But if you buy something that has marketing on it, like I have, like I put this logo on, this makes it deductible to me because it actually has a deduction called, and my hat too. They got hats, everything I wear. This is my uniform. I tell people, this is all I wear every day. Mr. Adam.
Hey, Tim, thank you so much for coming. Michele actually was asking those partner questions for me and my partner who can't make it right now. We have a team with 3 partners, and we did an S Corp that was based on all 3 of us being, did all that paperwork. And so that was, we found out the hard way with employer tax and employee tax and, these huge chunks of money coming out of our each individual check since we all produce at a different level. Can you go into deep a little bit more on what you said for the general partnership and then the S Corps for each of us as individual partners? Can you go?
Yeah, I can. It gets a little complex, for this setting, Adam, but essentially if you just have one S Corp for the 3 of you,
right,
it makes it too complicated because one person generates 20,000 that month and one person's 0, and they got to take it as payroll to equal it out. It becomes this big mess, right? And so what I generally recommend is you have the partnership that's like at the top. So you have the partnership that actually receives that receives the commissions for all of you. And then the partnership can pay out unequal distributions to its partners. That's the beauty of a partnership. It can be unequal distributions. So underneath the partnership, you'd have your 3 S corporations that you'd own by yourselves. And the beauty of that, let's say 10,000 comes in for you and 20,000 comes in for your partner. Well, that 10,000 then just goes directly to your S Corp, and the 20,000 goes directly to his S Corp. And then you manage that money by yourself, which allows you to pay your kids on payroll. So that doesn't affect him. It manages you to take that trip to Vegas for that conference you want to go to that he doesn't want to pay for. So it allows you to manage your money separately in your own entity. And so that would be the structure, Adam, is that you have a partnership that's like the top that gets paid, as the partner, as from KW would recognize that as who they would pay every month, and that would pay your joint expenses for your team, whether it be for advertising, and the rest you can split unequally depending on what you guys are producing.
So for that, for our team expenses, like our office and our tech fees and all that stuff that we use now, would that be a write-off of the general partnership?
It would be, yep.
And then that would also apply for like our buyer's agents or our agents that are producing now. Their team split or team commission would go to the general partnership, and
That's
then
right.
we take. Okay.
That's right. Yeah, and I've actually vetted that through an attorney. because you know, I had some clients that were worried about liability because general partnerships don't have liability protection inherent to them. But because the S Corps are the partners of that general partnership, you have that kind of liability protection.
Okay. Hey, thank you for taking the time to do this. I know 10 of us probably have a bunch of questions, so.
Oh, no, it's good. Questions are how I think people learn most anyway, rather than me just droning on. So feel free to ask as many questions as you want. Somebody asked, I write off my manicures, hair appointments, etc. Well, you know, for such you know, a beautiful lady such as yourself, Lisa, maybe we'll allow it, but no, technically you're not allowed to. The IRS is pretty clear that any personal grooming of any sort, no matter what profession you're in, any profession, is not tax deductible. And so we may have gotten away with it for many years for you. And sometimes I will do that because I think with anything within reason is gonna be fine, and the IRS will never question if it's low amount, but technically it's not tax deductible. Hi, Tim, what about client gifts? Most of us pay more than $25 suggestions. You know, this is one of those dumb rules in the IRS code. There's several dumb codes. This is one of them because obviously, as you all know, $25 gets you absolutely nothing these days, especially if you're giving client gifts. I've ignored this rule forever, just in my personal practice, just because it's kind of a dumb rule. If it got questioned by the IRS and the IRS agent really wanted to dive deep, and they say, hey, how come you spent $3,000 in client gifts? Did you have X amount of clients to make up for that? It would probably get disallowed in a real audit. And so one way I get around that is if you ever, you know, don't call them client gifts, basically. So if you're buying things, call it sales promotions, call it advertising, don't call it client gifts. Or if you want to get something, don't get your typical kind of like gift thing. Get like gift cards that you say, I use these for promotions and for advertising or something, or do something a little more creative that's more advertising or marketing like. That way you can call it a marketing expense as opposed to a client gift. So hopefully that helps kind of clarify that. But gifts, you should rarely kind of call anything a gift because it is limited technically. Janice asked, can you claim both gas and mileage? And the answer is no. You choose one or the other, Janice. It's whatever is more beneficial to you in your situation. So sometimes the gas deduction, along with oil changes, tire rotations, insurance, everything else may be more beneficial, but more than likely, mileage rate's going to be better. If you get decent gas mileage on your vehicle, the mileage rate's going to turn out better. Now, I'm up in Montana right now, and gas is still like at $4.25 a gallon or so. So you guys paying $7 a gallon. It may be more beneficial now to claim gas. You might want to keep track of both at this point, because I'm not sure what's going to pencil out to. But you can't claim both. You can choose which one or the other every other year if you want, whatever one's better for you. Can I deduct cell phone bill? Yes, Alice, you can claim cell phone bill. Cell phones are one of those things that we all know that we need to run our business these days. It used to be where you had to keep track of, okay, I use my cell phone for 70% of the time and 30% is business, whatever. These days, it doesn't really matter. You can claim 100% of your cell phone bill for what you do. And I've gone through audit with several of those. If you share it with somebody else, technically you can only get whatever your plan cost is for your plan. So if you have a $150 cell phone bill and you have two phones on there, one for somebody else and one for you, technically only half the bill. You don't have to get your own cell phone plan. You can just kind of write off half of that total cell phone bill, or whatever you're paying, I should say. Does this Excel sheet apply to not S corporations? That Excel sheet that you can download in the chats, you can use that to track expenses if you want. It's made for those who actually reimburse themselves for their home office at home, but for S corporations. But if you want to use that just to track your expenses, but by all means, you can do so. Mr. Bill asked, Tim, can a person go on a personal trip and set a business appointment for a meet and greet at a real estate office, or attend a training session and write off the entire trip? I feel like, Patrick, you already know the answer to this question. And the answer is, yeah, you can. That's a great tool to try to write off travel, is if you can turn it into a business trip. And real quick, I can give you an explanation. If you're gone for 5 days, over half of the time has to be business related for you to be able to deduct that trip. So over half the time would be 3 of those days. Well, if you're traveling for a business trip, the travel days are considered business days. And so the first and last day counts. You're already at 2. So you only need to spend 1 other day actually doing business to make it a business trip. And a 1 work day is considered about 4 hours a day, according to some IRS tax court cases. And so you just need to work for 4 hours on one of those other days. And by working, you could go visit a client. It's not just sitting at your computer working at Airbnb, but actually doing something in that location. So going to a training, visiting a real estate office, taking a listing or showing somebody a house down there, or going to a house or going to an open house and trying to make connections, something like that. Then you can deduct the entire trip. So that is kind of a trick to be able to deduct travel. Are you taking new clients at this time? Sorry if this was asked in the first 10 minutes of the meeting. Yeah, sorry, Adam. Right now, I'm not. Now, there may be a time where I can hire some more people. At this time, I can't provide the level of service to new clients that I do for my existing clients, and I in just good conscience, I can't do that to you as a new client, or I can't do that to my existing clients, just because there's only so many hours in a day, and so we treat all our clients pretty equally. And if I take new clients, it lessens the service I can provide to existing clients at this time, and so I just can't take on anybody new right now. So hopefully you understand. Can you write off home repairs for home-based business or improvements? Yeah, actually, Linda, you can. If you have a home office, which everyone here should have a home office, no matter if it's a little section of their master bedroom or a whole room, you should have a home office because people work from home these days. And you should be taking that deduction on your tax return. If the expense for home improvement goes directly into that home office space. So if you have one room set aside and you get new carpet in that room, that's 100% deductible because it's going in that office space. If you do carpet throughout your whole house, technically only that percentage is deductible. So it's part of the whole home office deduction. But anything done to that one room is tax deductible. So if you're painting or getting new hardwood, make sure you do it to the home office only, or make sure you kind of manipulate that so you're doing it to the home office section to get the 100% deduction as well. Hopefully that makes sense. Patrick asked again, can I still write off my first dry cleaning when returning from a business trip? That's a good question. The travel rules state that anything that you incur while away from home is tax deductible. So if you happen to be away from home on a travel business trip and you have to do dry cleaning, which dry cleaning typically is not deductible because it's part of that uniform kind of expense I was talking about. You can't just dry clean, a suit and tie and call it a business expense because you can't deduct uniform stuff unless it's actually uniforms. So the dry cleaning when returning from a business trip, that's kind of a gray area. I would say, Patrick, technically no, unless you do it while you were on that business trip. If you pay for it while you're on that business trip, it's tax deductible. If you do it when you're home, it's not tax deductible. Hopefully that clarifies that. Can you deduct travel expense if it's with a boyfriend you live with as your client? So you're paying for your boyfriend too. Maybe he needs to get a job. No, I'm just kidding. Can you deduct travel expense? I would say within reason, yes. I mean, your boyfriend, usually, if you're going to travel with a client, it's probably a one-time deal. You're a real estate agent. You sell somebody one house and you move on. Maybe they come back to you later, a couple of years. But if maybe it's one travel trip, not if like you're going, to Napa every other weekend with your boyfriend, that really doesn't count. I mean, that's not kind of like an ordinary and typical business expense is to take clients to Napa every other weekend. So hopefully that clarifies that. Maybe one trip or maybe 2 at the max for something like that, but not on an ongoing basis. How to prove travel trip deductions if getting audited. If you have the receipts for your travel expenses and you have the calendar that shows what you did while you were gone, and you have maybe a receipt that shows you went to a real estate office, or if you have an email corresponding with the broker to that real estate office, let's say you go down to Carmel and you visit the KW down in Carmel or something, and you have a correspondence back and forth with that broker saying, hey, look forward to come seeing your houses. Who cares if they know you or not? You can kind of correspond with them, and then have that as proof of your travel. And that's kind of how you would prove travel expenses. Hopefully that's the kind of the same receipt for a business trip. Is this kind of, you kind of got to keep on your calendar. You got to keep your expenses documented. That's unnecessary praise from Janet. Thank you. I missed the answer to the marketing, advertising, clothing question. Sorry, can you revisit? Bianca, you can deduct uniforms, and uniforms are like stuff that has like logos on them, like my shirt, my hat, stuff that has KW logo on it, stuff that has like a slogan on it, polos that you wear for open houses, that sort of thing. But you can't deduct that nice blouse or dress that you normally wear going out with your girlfriends. Hopefully that clarifies that. Michelle just wanted to be sure this is being recorded, so I won't say anything more about what I do. Digital receipts are okay. You can keep digital receipts. Can I write off both the home office and office space at an actual office? Yes, you can. That's actually clarified in the tax court rules and regulations. So even if you have an office that you rent out in town, you can still deduct your home office, as long as that home office is where you deduct the majority of your secretarial duties, essentially is the term. So as long as you do the majority of your like stuff from home, as far as scheduling, corresponding with clients, you can still deduct your home office, and also have an office space that you rent that you deduct as well. You can have both. Cool. That was all the questions for now. Michele, did you have anything?
No, I love all these questions though. This is awesome. Thank you so much. Okay, you guys, this is it. You're not going to see Tim until next year. Make sure you have all your questions out there. I don't want to text an hour from now. Go ahead.
Well, what I was going to say is, I'm kind of changing my mind though, because I was going to say maybe they can give questions to you, and you can like give me an email, like follow-up questions maybe next week or something. But if you want to do that, we can do that. We can figure that out.
Okay. I promise you,
question. Oh,
I will wait to email you, and I won't sporadically be emailing you, because I know where you're going with that.
Yeah. Don't want to give people actually written guidance that's concrete when they're not clients. Yeah.
Yes. Got it. Tim, thank you so much. You guys, thank you for participating. I really appreciate it. And remember, we're doing our July 5th. We'll be doing our mastermind with the ALC and a few of other guest speakers of our agents. I have Lisa coming on, Lisa Aguilera, Patty, Taylor, Miguel, Janet. So there's a lot of people who will be participating. So make sure you are on this call. Tim, thank you.
Oh, you're welcome.
I appreciate you.
One last question I see, just want to address it, that Alice asked, how will we know when we're taking on new clients? You won't, but I'm sure you'll hear it at some point, if we do.
I'm sure you'll tell somebody.
Okay, well, thanks guys. Thanks for listening. Hope you learned something. The tax code is ever changing and getting more complex every year. So yeah, I know it's confusing, but hopefully you guys are all getting good sound advice. And one thing is, don't be afraid to be a little more aggressive, because, you deserve it.
Thank you so much, Tim. Take care, everybody.
Bye guys. See ya.
Happy Monday.
You too. Bye.
bye.